the Reinsurance Podcast, Episode 10. I'm your co-host, Jared Lee, as always joined by Ben Rose, and this week for our special 10th episode, Tom Spier joining the podcast. Welcome, sir.
Pleased to be here. Thank you for having me on.
Welcome to the chaos which is the Reinsurance Podcast.
It's less chaotic than I imagined it to be.
We're in a new venue today, which we like a lot. The couch is kind of cool. We get this new vibe, but it's a new space to accommodate some special guest stars. We might come back, see how this one goes.
Absolutely. I was very excited to see that we got a new sofa by bringing Tom along. So yeah, you might have to come back if we get this every time.
I'm glad to help in some way, contribute.
It's the luxury life of podcasting.
The mate.com sale loves you.
Indeed. But we brought Tom on today because we wanted to dive into the world of cyber reinsurance. We've talked about before anything that can be insured can then be reinsured, and we've started leaning into the nuance of what the sort of weird and wonderful stuff we can do in the industry. And we've heard a lot of feedback around sort of the rise of cyber and technology and the risks associated. So we thought we'd bring you along for the ride and just sort of batter you with random questions and stories and wisdom around the space. So welcome.
Thank
to
you.
This, yeah.
No, I'll try and help where I can. I got into cyber insurance in a really kind of weird roundabout way. So it wasn't actually from the insurance angle. So hopefully I know the answers.
Perfect. So how did you get into this world? I'd be curious to hear your strange journey in, like all insurance journeys.
So I actually started getting into cyber insurance by working for a company that did identity protection. So in the US, you can buy various services that give you protection against people stealing your identity and identity theft, financial fraud, that kind of thing. And so there's a set of assistance services. Probably the closest thing in Europe is like AXA Global Travel Assistance, or whatever, but specifically for your identity. And so a set of amazing data protection and privacy professionals that just really wanted to get into the insurance world. And so we started converting those services into something that would work in insurance.
Nice. And I know it only escalated from there, because whenever we go into town, we always end up bumping into, I say town, for non-reinsurance listeners, basically anywhere in the square mile of the City of London, so the Leadenhall Market, etc. But any time I'm in town with Tom, we somehow end up bumping into like 50 different cyber underwriters that Tom knows and brokers and so on. So how did you end up getting in then from there?
22-year-old global head of.
It's a new line of business, right?
Yeah. It was, and I think that's how kind of reinsurance started to come into its world, because it was a brand new line of business. When it started in the 90s, it was this weird insurance cover against middle of the dot-com bubble. There was mail order liability policies effectively for dot-com businesses. There was an indemnity policy you could buy against the effects of the millennium bug. Sure. You remember that?
Yeah.
Planes falling out of the sky and things like that.
Made a lot of money with that policy.
Never happened. Yeah, exactly.
Pure profit.
And then it started to move towards kind of privacy liability policies, which protected against the risks that were arising because of new privacy legislation. So the world started to get wise in the early 2000s to the fact that actually if somebody gives you their information and you lose it, that's your fault, and that's a bad thing, and they might be able to sue you for that. And so all of these big tech companies wanted protection against those laws, and cyber insurance was very narrow. It was all about privacy liability originally, and then as the product came over to Europe and people don't sue each other as much, then there was appetite to get the cover wider and wider and wider, and business interruption, and then contingent business interruption, and then and all kinds of financial crime covers came into it, and it it became something that insurers just couldn't take the risk on
Yeah.
themselves.
Yeah. And I think there's really interesting areas where in certain parts of this, it's relatively straightforward. You have a suite of identity restoration services and other things that, if a claim were to happen, the insurance will pay for these things to be deployed to support you in getting back up. But then you look at these massive like hacks, like a Sony hack or similar. It's really been difficult for the industry to sort of quantify what that loss is. We know that the loss of all these records like hurts the brand of a Sony. Like, and there could be business interruption from they can't do something until the servers are restored or similar. But actually quantifying what that loss is, it's sort of difficult in an industry historically where it's like this property has a value or this vehicle has a value, like that we could very easily align what was lost and how to repay that. But cyber's always had a bit more nuance to it, which makes it a really interesting case study.
I think that's what we found as the product developed and our company developed. I think at the beginning, identity restoration services were pretty much the only thing you needed. We found if there was a claim, we were dealing with that ourselves. And nobody else was really involved. And maybe a lawyer, if it was a healthcare information or something like that, where there's a specific liability exposure. But by the end, 6 years later, by the time I left that company, it was you were working with PR firms, you were working with specialists, incredibly clever specialists who work out the specific business interruption impact from that event. And it could be as simple as, our Instagram account went down, and that is the source of this much business over this much time, and that's how much our profits dropped by, and kind of all these really complicated calculations involved by the end, and still now when you look at events. I worked on the Sony event, actually.
Did you?
Yeah, so part of the settlement there, after they exposed how much certain actors and actresses were being paid, and they got very upset because they realised how much they were being paid relative to each other. They paid for a load of services for all of the employees that had been victim of it in 20 different countries or something. So we handled all of that for them.
That's fascinating. Yeah, I wonder that. I mean, that's a nice tangent into something we had planned for you as we talk about movie stars. Jared's used to me bullying him with Frisk kind of things, so we thought you could be our victim.
I have seen this before.
Yeah.
I'm excited to be on the delivery side of Frisk instead of the recipient.
So Jared and I have brought actually 2 film-related Frisk for you. One of ours is real, one of ours is fake, and you have to work out which one is actually true.
Yeah.
Apologies, by the way, if you are listening and you are a movie star involved in this example. Yeah. Which is quite likely given this.
We've made it in the world if these if these forthcoming examples are people listeners of the podcast. Should I go first? Do you want to?
After you.
So which of our 2 Frisk is a real risk or a real claim?
You can do one each here.
One each. Yeah.
Okay.
Yeah.
Okay.
Don't look into our eyes.
So then it makes one of you branded a liar for the rest of the episode.
Oh, we should do this at the end.
I mean, my reputation's already been sacrificed.
Yeah, exactly. Yeah. So, in the filming of Troy, Brad Pitt was playing Achilles, tore his Achilles tendon, and had to delay filming for several weeks. Or Ben's in it.
And in a similar vein, the character Legolas, played by Orlando Bloom, fell off a horse during filming of the second Lord of the Rings film and broke his leg, which was equally ironic. That Legolas broke his leg and Achilles pulled his Achilles. But which of those 2 is the risk that needs to be frisked?
I think that Jared had the real risk. No, I don't.
Ooh.
I don't, because you changed your story midway through. Originally, he tore his Achilles and then he pulled his Achilles.
That's a very fine nuance.
It's legless.
No, it was the torn Achilles.
Goodness me. I appreciate the nuance with which you approached it, though, because I back in the day, I remember actually I did PE theory, PE for our non-UK listeners is like gym or
Gym
sport.
class.
Yeah, or something like that. But yeah, we had to learn all the difference between like a strain and a sprain and a pull and a tear, and clearly I've forgotten all of them. And for me, it was just he hurt his Achilles in some way. So yeah, but
I think, is it ruptured, torn?
I have no idea. No idea anymore.
I'm sure there's, again, we're having friends of our podcast probably shouting at us who are in the physio world. They're like, no, it's not pulled. We're not doctors. Don't take medical or financial advice from this podcast.
but well, yeah. I mean, I was gonna say well done, but almost well done because you got it right the first time. And then
Was that
I
the strategy to say the one, then change your mind, so you've technically chosen both, so you can always claim victory?
Well, no. So one of my early jobs in insurance was investigating potentially fraudulent claims.
and there you are.
So they trained you up in this kind of pseudoscience that I don't think ever really existed, but it kind of with cognitive interview techniques.
Yeah.
And so you get somebody to kind of as freely as possible tell you a story, and then dive into detail in certain areas and analyze where they voluntarily applied detail, where they didn't, and where people's stories were changing and things like that after they'd, had their car stolen whilst they were on a night out and it miraculously turned out up at the side of the road, burnt out.
Yeah.
But yeah, so I was probably coming back to a little bit of that.
Spotting continuity errors, which again is very appropriate for our film-related analogy. But anyway, back to cyber. I think one of the things we wanted to cover in this episode as well was the complexity around cyber, which initially, as you pointed out, was a bit of a niche and has just expanded and expanded and expanded. How does cyber now fit in with other lines of business, I guess? Because increasingly, our properties and property insurance has some kind of weird overlap with cyber elements, and our liabilities have relationships to, I think one of the great examples is autonomous vehicles. What happens there with liability? Is it the car that goes wrong, or is it the software driving the car that goes wrong? How are you seeing that space evolve as cyber starts to perforate other lines of business?
I think it's always been part of all of these inherent risks, and I think people have been looking at it as a new line of business since the early 2000s, but it's not really a line of business at all. You can't look at it like property, like casualty. It's a peril. So you would look at it in the same way you looked at fire or flood, and actually look at how that is built into so many different lines of business. And so losses due to cyber could appear on any kind of policy. I think the reason that it emerged as a specific line of business is that the expertise are quite specific. And so in the early days, in fact, lots of the very, very clever, very senior underwriters in the market today were in the IT department before they got moved over, and then kind of became head of cyber, and that department grew out. And so because those expertise were specific, they lumped them into one department. It kind of became a line of business. I think as the product evolves, eventually cyber elements will just be intrinsic in most insurance policies around there, around the market. I don't think it can possibly continue to be a specific line of business.
Is this kind of then where the phrasing of silent cyber comes from? This idea that cyber is kind of embedded in places and it's not sort of exposed in the cyber book that we wrote with very specific cyber policies, but rather this recognition that there are cyber exposures sort of underlying most of the stuff that we're writing and exposing ourselves to.
Well, absolutely. And silent cyber has created a reputational risk for our industry. So for those that are less initiated, I guess. So in a property or a casualty insurance policy, you will cover, loss of profit due to business interruption, and that policy may be what's known as an all risks policy. So they don't specify how that business interruption needs to happen. It just, if there is an interruption to your business, then we will cover those losses. And they didn't mention cyber specifically, but when they originally wrote that policy wording, they didn't envisage a world where your business would be interrupted due to a virus or some kind of cyber attack on your infrastructure. And so they didn't specifically include it or exclude it in the policy. And so there are these exposures in other policies due to cyber that just exist. Yeah. And there's been some case studies that have been incredibly bad for the reputation of the industry, where property policies have declined claims and failed to respond to cyber events when a specific cyber insurance policy would have responded to that event. And so it gives people the impression, let's be honest, the impression that most people on the street have, which is that insurers just take your money every year and they want to get out of paying any claims, and they're in it for themselves. It kind of propagates that reputation.
Yeah. Well, and I think business interruption, especially for like companies now, it's this recognition that we live in a hybrid world where even if you go down to like a Selfridges or a John Lewis or these sort of stores that have a physical footprint, someone taking down the website for a handful of hours has a direct and measurable impact on the revenue that the business would have taken. So there's the online and offline sort of things that happen concurrently.
A tiny business. So we used to deal with claims like, a high street hairdressers, and they lost access to their appointment system. So they didn't know who was booked in when, with what hairdresser.
Yeah.
And they just completely fell apart. They weren't able to trade that day.
Yeah.
Just because they'd lost a diary, effectively.
Well, and Ben, you mentioned the example of like the big scary cybers, like what happens if someone hacks all the autonomous vehicles and crashes them into but there's all these little like micro cases that in the aggregate can be quite damaging.
Yeah, I think the people that are responsible for this, I think people have several ideas in their head of either the 400-pound guy in a hoodie in his mum's basement hacking away to try and be the top dog or get one over the security services or kind of nation state attacks. Most of these guys are fraudsters there to monetize what they're doing. And so either they'll, drop a ransomware attack, which is available. You don't have to be particularly skilled to pick up ransomware on the dark web and then deploy an attack on somebody and extort money from them that way. It could be scams. I think everybody has the Nigerian prince emails in their inbox on a regular basis. Interestingly, those are actually down edited.
Intentionally.
Intentionally.
Yeah. Do you want to explain this?
Well, so their theory is that if they make lots of intentional mistakes in the email and it doesn't look genuine, the only people that are going to reply are the stupidest people. And therefore
the most vulnerable people. we edit slightly. Carry on.
The most vulnerable people. We can say that. But the people that are most likely to eventually hand money over effectively, because they don't want to be wasting a lot of time with people who are never going to give them money at the end of it and communicate with them. And certainly a lot of people like to have a laugh with them as well.
Yeah.
No, it is fascinating. And I guess one of the angles then this brings up is, given the way the risks present themselves to individuals and to organizations, as somebody selling cyber insurance explicitly or not, how do you start to price the risk of these different companies? Because I know measures haven't been perhaps as readily available for how well protected a given risk is today. I know there are some things emerging. For example, at Supersede, we do our ISO 27001 certification every year. I think we got that first 3 years ago, way before it was cool. But even now, I've not been asked by our insurers, do you have one? It's sort of just, oh, you're an organization of this many people, so here's your coverage.
Well, and that's actually a really good measure because that's all about risk management. And do you have this procedure in place, that procedure in place? So ISO 27001, NIST is another one that's used by American financial institutions typically. They're very, very good indicators. I mean, you guys should do a whole episode on this, but I would ask, what proportion of reinsurance in total is priced based on the underlying risk? Actually, I would say 10%, 20% of it. Cyber insurance first came out. There were almost no claims. These guys were running at 22% claims ratios on their books, and so the price was just plummeting because they were trying to load more business onto the books. They were trying to make it easier to buy the policies. So there were insurers in the market that would sell a policy based on 2 questions that you answered, and everything was about how easily can you get customers in the door, how quickly can you underwrite these policies, how can you build up big volumes of book, and so the price dropped, and that was market led. And now that the market's hardening, it's not because the risk has gone up, it's because the access to capital has been restricted, because the reinsurance market is less keen to kind of float these underwriters that have spent 10 years asking 2 questions and creating a book that is actually very homogenous and looks exactly the same, and then they're surprised when you spend 10 years building a book that looks completely homogenous, and then suddenly you have an aggregation problem, and they seem surprised about it. It makes me laugh. But I don't think cyber's, to answer the question directly, ever been priced based on the risk.
Yeah, amazing.
It's kind of these external factors.
And on that point, so I think we'd be remiss not to enjoy the creativity of some of the cyber attacks that have happened and hit the headlines in recent years. I mean, what sort of risks have you seen in the Hall of Fame, I guess, of, I don't want to celebrate them too much, but infamous cyber attacks?
There's a lot of famous ones. I'm not a big fan of trying to sell insurance based on fear, and scare people into buying something that as someone that's run sales departments, I don't think that's an effective way of selling something and keeping a customer for a long time. Keep them frightened. It's like an abusive relationship.
No, exactly.
But I think there's a lot of massive events that have happened that, for luck or judgment or a bit of both, haven't really affected the cyber insurance community as much as they could have done. So things like NotPetya, which was apparently accidentally got out in the wild as part of a nation state incursion. That could have been very, very bad for the cyber insurance community, but people the time that it was released was a massive influencing factor in it. So people were waking up and they were affected by it, in China, in Russia, across Eastern and Central Europe. Areas, by the way, with very, very high software piracy rates. So their software wasn't patched up to date and didn't have protection against this virus, and so they were very heavily affected. By the time it got to Western Europe, security researchers had been working on it for a long time, and were actually able to, they registered a domain that effectively neutralized the worm capability of the virus, so it was unable to replicate certainly as fast and actually not at all from that point. And so by the time the Americans woke up, and Americans buy 90% of cyber insurance, this virus wasn't something that would self-propagate and spread. And so the Americans woke up, turned on their computers, and the impact was not large. So those kind of big attacks, I think the industry's been able to swerve so far.
I think it lends itself interesting to this sort of protection gap, if you can call it that, but things between actual losses and insured losses. You know, we look at events, if you think about simple catastrophes, events around an earthquake in a geography, but that doesn't have a lot of insurance that's purchased. The impact is still felt, but the insurance system isn't there to protect it. This seems something similar, where whilst all of those, you know, privacy rights were violated and data was stolen, etc., those aren't geographies with huge amounts of cyber insurance purchasing happening, so there wasn't a protection mechanism in place as such.
Right, and because of the way that predictive analytics and loss modeling works, that event didn't happen. As far as the insurance community is concerned. It certainly happened.
It is super interesting, and I think we're still at a relatively early point of innovation around, you know, as you said, whether we'll get to the point where we start actually taking into account the right factors for pricing, but all the same, trying to keep up with changing attack vectors and things as well. So when I was at Aon, I joined a collab with Startup Bootcamp to focus on emerging threat vectors for cyber, and we were looking at IoT specifically. You know, what happens if somebody gains access to your systems by, you know, going in through your phone system, or I think we used the example of the electronic blinds in the cheese grater, or I think there's a famous example involving a fish tank, if I remember correctly, where somebody managed to gain access to a system through
I saw a demonstration once from a guy that was determined that you could burn someone's house down with their coffee machine over the internet. So you could hack into it, and you could turn off all of the safety protocols, and then just boil water again and again and again and again in this coffee machine, and eventually burn a house down. I don't think it's ever happened in real life.
No, but it's these sort of things people are starting to think about. I mean, one of the examples that came up in our collab was things like, particularly with malicious intent sort of scenarios. Hospitals use a heck of a lot of connected infrastructure. You know, if you're able to just turn off someone's life support machine, that's pretty brutal. Or, you know, we've seen a lot of interstate attempts to disable energy infrastructure of all kinds. It's an area that feels. I mean, we hope as non-cyber specialists that the cyber specialists are constantly looking at this sort of thing, to take account of where it could go. But yeah, that's probably the more scary side. But I think probably
I think the property damage side, or the, you know, personal injury side even of it is something that gets a lot of attention, and it's kind of sexy. I think the bottom line is that the market has always been driven by the boring thing, which is government legislation.
So should we talk about GDPR and data?
Well, that was the, you know, the big thing that originally kicked off the market was California passing their privacy legislation in 2003, which was the first time that, you know, you had to look after people's information properly, and then GDPR in Europe, and then the California have added additional protections recently, last couple of years. And then, you know, Canada and South Korea and Japan and all of these countries have added, you know, very, very stringent data protection requirements. And you know, again, they've been used by the industry as a way of scaring people into parting their money a little bit. This legislation is not frightening. You know full well, Ben. You went through the ISO 27001 process and all of the data protection requirements around it. people are worried that the regulator is this big bad beast that's going to come out and go after you just for trying to do your business in a normal way.
Mm-hmm.
The only reason they're going to come after you is if you're trying to not do right by people. And actually, if you take, the idea of privacy by design, which is, or privacy by design to translate, it's a concept that people think is very European in terms of privacy being a fundamental right. But all it really means when it boils down to it is do the right thing by people. If somebody gives you information, that's theirs.
Yeah.
So ask if you're going to use it for something.
Mm-hmm.
Don't use it for stuff that you haven't told them you're going to. And for God's sake, look after it.
Mm-hmm.
And it's as simple as that, really. And I think organisations overcomplicate this stuff very quickly.
And to your point, I think it's used to try and sell extra things to them all the time, not just insurance, but all sorts of things. I've seen a few companies campaigning around with advertising that says things like, "We'll help you become officially GDPR compliant." And actually, when you look at what's embodied in the UK, the Data Protection Act and other forms of legislation, there's not a line. It's not like there's a tick these 3 boxes and you're now GDPR compliant. It's such a hazy issue. It's about, in everything that you're doing, are you being fair and transparent and legal with, consideration given to the proportionality of things you're doing versus your legitimate purposes. It really is a case by case by case process. Again, there definitely are emerging best practices that we stay on top of, but even between regimes, there's so much difference in interpretation.
It really is a case of don't be a dick. It should be the legislation.
Yeah.
When it's there, if you have people's fundamental rights and doing right by people and by the companies that you work with at the heart of your organisation, you'll be absolutely fine.
Yeah, absolutely. And I guess relatedly, you've got that point. Don't be a dick. The new catchphrase of the cyber episode. You've got that side of
the
things.
first bit of bad language on the.
It is. Yeah.
I think I swore in an early episode.
Maybe.
Well. Yeah.
Probably.
We rated 12A now.
Yeah, I think we must be.
It's going to have to introduce a podcast,
But-
rating system.
But I guess you have that side of things, but you also have don't be negligent as well. It's sort of, you have to show that you haven't fallen below the threshold of what would be considered, dutiful. You have a duty of care, as you said, to anyone who gives you their data.
Yeah.
And you need to make sure that you have the processes and systems in place to make sure that you are really taking care of their data properly and that you're managing it successfully. And I think that's something that's been introduced too late in a lot of cases for larger firms. I think we're very lucky that it's been on top of our radar since we started, so we've sort of just grown it out at Supersede. But I think I remember actually being approached when we got our first certification in 2019 by a bunch of Lloyd's syndicates, other big tech providers, all being like, how do you get this? It's pretty onerous and complicated kind of thing. And it is, because you really do have to think about a lot. You have to think about a lot of potential scenarios and think, am I accounting for every process that we undertake as a business, all of the exposure points, all of the data maps and process flows of where information you take in ends up, how long it's retained, how it's stored, how it's shared, etc. And it requires, like many things, a whole new role, a whole new function in big companies to just make sure you're doing this.
Yeah, and I think this is one where, much like the rest of the industry, we will see a natural evolution of things being exposed and things being protected against. But we'll probably have dozens of cyber conversations over the course of our podcast. So, super interesting conversation, Tom. Thank you for joining us, and thank you guys for listening to episode 10, milestone episode of the Reinsurance Podcast.
Yeah, and I hope we get to keep the safer, even if we don't have you next time.
Exactly.
I should add that it's in association with Supersede.
Always.
I wouldn't be doing my job.
Thanks, everyone.
See you next time.